Today, we're diving into a really old economic rule that explains a whole lot about our modern world. It explains why you might be holding on to your Bitcoin for dear life, but have no problem spending the dollars in your bank account. It's this wild idea that connects ancient Roman coins to the crypto on your phone. So let's get right into it. Have you ever stopped to think about this? It's kind of weird, right? We live in this increasingly cashless world, but the actual amount of physical money out there is growing. And at the same time, you've got people treating things like Bitcoin as this precious digital gold, something you just don't touch, while they're happy to spend their regular government money. It feels like a total contradiction, but believe it or not, there's a perfect logic to it. And to really get our heads around these modern puzzles, we actually need to look backwards, to a law that people have been noticing for centuries. Okay, so here's the deal. Economists call this the cash paradox. We're all tapping our cards, our phones, you know the drill. We're using cash less and less for our daily coffee. But at the same time, people are holding on to more physical cash than ever, especially those big $100 bills. So what's going on? They're using digital money to buy stuff, but they're stashing physical money away like it's a treasure. Why? Well, the answer is hidden in this simple, super powerful idea. You've probably heard it before. Bad money drives out good. And that's what we call Gresham's Law. Now, the key ingredient here, the thing that makes it all happen, is that a government forces the issue. It says, these two different things, they're equal. You have to accept them as equal. But the market, the people, they know better. And that's when human nature just completely takes over. Look, think about it like this. You're standing in front of a vending machine. You've got two coins in your hand. One is a rare, pure silver coin that's a collector's item. The other is just a regular old nickel. The machine says both are worth the same, enough to buy you a soda. I mean, come on, it's a no-brainer, right? You're going to spend that plain old nickel and slip that beautiful silver coin right back into your pocket. See? You just followed Gresham's Law without even thinking about it. So let's really break this down. Good money, that's the stuff that's actually worth what it says it is, or maybe even more. Think of that silver coin. Its value comes from the silver itself, not just the number stamped on it. Bad money is the opposite. Its base value is only there because the government says so. But the material it's made of is cheap. So what do people do? It's only natural. They get rid of the bad money as fast as they can and hang on to the good stuff. So you can see how this plays out step by step. First, some law creates this artificial situation where two unequal things are declared equal. Then, people just act logically. They're not dumb. They spend the junky currency and save the good stuff to protect their wealth. And before you know it, poof, the good money is gone. It just vanishes from everyday life. It's all stashed under mattresses or shipped overseas where it can be traded for its real value. And what's so wild about this is it's not some modern idea. This exact same thing has been happening for literally thousands of years, way before anyone put a name on it. Long before Sir Thomas Gresham was advising the Queen of England, brilliant minds throughout history were all pointing to the same phenomenon. You had ancient Greek playwrights making jokes about it, medieval scholars writing about how it was ruining society. Even Copernicus, the famous astronomer, took time off from looking at the stars to write about how bad money was wrecking his country's economy. I mean, listen to this. This is from a play from 405 BC. Athens was in the middle of a war. They were short on silver, so they started issuing new bronze coins with a thin silver plating. And the playwright Aristophanes immediately noticed that people started hoarding their old, pure silver coins and were only spending the new, crappy, sorry brass ones. The exact same dynamic over 2 millennia ago. It's just timeless. If you want a perfect, real-world laboratory for this stuff, just look at 19th century America. The government kept trying to fix the value of gold to silver. So in 1792, they set the ratio at 15-1. Well, that made gold way too cheap compared to the rest of the world. So guess what? All the gold coins got shipped out of the country. So then, in 1834, they changed the ratio to 16-1. But whoops, now they'd made silver too cheap. And you can guess what happened next. All the silver coins vanished. Okay, but what if the bad money gets so ridiculously bad that it's basically worthless? Well, that's when the law does something incredible. It flips completely on its head. And there's a name for this, too. It's called Thiers Law. This is what happens at the absolute breaking point. When a currency is in a death spiral from hyperinflation, those legal tender laws become a joke. People just flat out refuse to accept the worthless bad money. And that's when the good money finally comes out of hiding to save the day. So here's the key difference between the two. Gresham's Law is what happens when the bad money is still, money. It's just not as good as the other stuff. But Thiers Law, that's what happens when the bad money has become trash.
the behavior totally flips. You go from hoarding the good money to completely rejecting the bad.
Take a look at this. A $100 trillion bill. This was a real banknote from Zimbabwe in 2008. When your official money gets to this point, it's game over. Nobody wants it. Even though it was the legal currency, people just abandoned it and started using the US dollar instead. The good money, the stable US dollar, literally drove the bad money into extinction.
All right, so all of this history, these old economic laws, it brings us right back to where we started. We finally have the tools we need to solve those modern money mysteries.
So let's ask it again. Why are people hoarding Bitcoin? Why are they stashing away physical cash? I bet the answer is starting to seem pretty clear now, isn't it?
Yep, it's Gresham's Law playing out right in front of us. That cash paradox? Simple. Physical cash is seen as good money for saving. It's private, it's tangible. We spend the bad money, the convenient but less tangible digital dollars on everyday stuff. And Bitcoin? Well, with its unchangeable fixed supply, a lot of people see it as good digital money compared to government currencies that can be created out of thin air. So they hoard the Bitcoin and spend the dollars. You even see this in DeFi with stablecoins, where the most trusted, best-backed ones are held in reserve while the riskier ones are used for day-to-day trading.
And that's really the big lesson here at the end of the day. Gresham's Law isn't just about coins. It teaches us something fundamental about value itself. You can pass any law you want, but you can't just decree what something is worth. When you force people to pretend that two unequal things are equal, the market will always figure out a way to separate them. People will spend the bad and they will save the good. It's a principle as old as money itself, and it's still shaping our world every single day. So the next time you choose to tap your card instead of using cash, just ask yourself, which one do I think is the good money?